Welcome to another video of our podcast, Market on Cues. I hope you had an amazing year. Without further ado, let me just start with the first question. The first half of 2025 saw a surge of AI stocks and a weaker dollar and tensions within the Middle East. What surprised you the most? And what's your biggest worry for H2?
First of all, Vinu, welcome to you. It's good to be talking to you for the first time. Yeah. And yes, like all of us, my portfolio is doing okay. In terms of your question about what surprised me about the first half, not much surprises me about the market these days. Having said that, I think I was very pleasantly, mildly surprised about the resilience that the market reflected. You and me have done this paper about, when there is an extraordinary event on war and all, how the market behaves. And yes, the markets do come back whenever there is a knee-jerk reaction and is a decline in overall performance of the market on the back of geopolitical risks. Yes, they do come back. But this time what surprises me was the speed at which they came back. Like in a span of 6 months, we've seen drastic news with wars and with the Trump new administration coming in and announcing very drastic things about tariff and all. And market did fall 20% almost in April. But pretty much by June end, it not only had recovered the fall, but plus more. So we are now almost 5-6% above where we started the year. So this level strength and this level of resilience in the market was a very pleasant surprise for me. Second half, I think I'll expect this to continue, the strength to continue. I see quite a few positive catalysts possible. There is the new tax bill, which is going to be a bit boosting of the GDP growth. So the GDP growth might begin to pick up in the US at least. There is some talk about the deregulation. The tariff talk is more positive than what the headline showed in April. Geopolitical tension seems to have subsided quite a bit. So overall, I'm very constructive and positive on the second half, barring a little bit about the inflation. Because inflation in the US can be a wild card if that gets out of hand, particularly on the back of tariff concerns and things like that. And if that translates into Fed taking a different stand on rate cuts and all, market may need to reprice that. And that may cause a little bit of hiccups. But otherwise, overall, I'm quite comfortable in saying that we expect market to remain in positive territory, somewhere between 5 to 10% of the growth for the whole year.
So the S&P 500, it reached new heights, and 3 of them were AI stocks. Do you think it's maintainable?
So I think you're talking about the sustainability of the concentration in the AI stocks,
yes.
Right? So you're right that roughly 50% of the gain, if you look at the headline gain, seems like it's come from technology stocks, particularly AI one. Yeah. But that's just the optical illusion of, because the AI stocks and the technology stocks have exaggeratedly high contribution in terms of the market cap. They are big cap stocks, right? So it feels like the gain, they tend to contribute the most gain. But if you keep aside the market cap level calculation and look at which stocks outperformed or did very well in the index. I mean, S&P index is more than 500 stocks in there, right? Then the top 5 performer in the last 6 months were actually not from the AI space. It's like I think the top performer is NRG Energy, yeah, which is an energy player. Then there is Newport, which is actually a mining name. Then I think the third was Humart Aerospace. Yeah, which is, again, yes, you may call some technology in there, but it's more aerospace related thing, not particularly AI. So if you look at the top 10 best performing stocks, the sector industrial is actually, as a sector, the best performing sector. Industrials in S&P index were up by 12% in the first 6 months, whereas technology stocks were up only by 7%. So it depends on how you're looking at the market. If you look at just market cap and absolute numbers, then it may be AI stock. But if you look at prorated percentage growth year on year into the stocks, then other sectors are doing reasonably well. For an investor then, if you are only playing an ETF based on S&P index, and then you run the concentration risk. But if you are taking either the subsector ETFs or individual names and stocks, then that risk doesn't exist.
Emerging markets have diverged diverged sharply. India boomed while China stalled. Which emerging market will be ripe for H2 of 2025?
If I look at developed market versus emerging market, I am in the camp of emerging market this year, particularly, right? Within the EM, the large economies you've already mentioned, the China, the India, the South Africa and Russia are not deep enough markets. You can't really trade them much. So in that space, Asia, ex-Japan, because Japan the economy runs on a different engine kind of thing. Most of Asia, I'm quite positive on. Between India and China, I would prefer China. China, to me, is actually a good trade for the second half. The Chinese economy is on stable grounds. The Chinese government is making structural changes. The regulations are changing to support economic growth. Because the dollar is on a weakening trend, it supports the Chinese currency. China has a big population, so there's plenty of domestic demand in there. And most of all, the Chinese stocks seem to me undervalued on a relative value basis compared to the rest of the world. So I'm a pro-China. Now, I know Chinese stocks have lagged behind in the last 4 years, and this call has consistently been challenged. But now, looking at where the dollar is and where the developed markets are, I am more convinced that this year the second half should be a game for Chinese equities.
Perfect. Ma'am, my next question to you is, what would be your top trade for H2 of 2025?
Vinu, as an investor, I don't put all my eggs in one basket. So, sorry, I may not say one trade, right? But if I pick one theme from each sector, let's say in equities, as I said, China equities is my favorite spot at the moment, based on valuation. Yeah. In the bond market, yes, US rates are going down, so any short-dated US dollar bonds will perform well. But I think a lot of that expectation is already factored in. Yeah. So I'm more, if I try to find value, short-dated sukuks from the Middle East is actually quite a good option for me at the moment. So in the bond market space, I will take that. In the commodity space, I will say the boring name gold. But the gold is, a lot of people don't probably realize or put time enough to analyze what is supporting this stellar improvement in gold prices in the last 2 years, 3 years, whatever. So what's happening is, because US is using the dollar, is weaponizing the dollar and impose sanctions on countries that they don't like, right? Like we've seen in Russia, Iran and all those. The emerging market governments and a lot of other governments have begun to realize that they don't want to become victim of the dollar weaponization, and sanctions obviously impede their ability to boost their reserves if they rely only on dollars. So to maintain the strength of their currency, as a reserve, the central banks have started buying gold instead of buying as much dollar. So it's moving the reliance away from dollar into gold. And it's that demand from the central banks which is providing a floor under the gold price, and which is basically putting that steroid in gold prices. So I'm surprised. There was a time 2 years ago when gold was hovering around 2,100, 200, and I was saying it's time for consolidation. But now when you look at the underlying thing, where the demand is coming from, I'm not surprised it's crossed 3,000 mark. And I think this trend will continue. So there is good support for the gold price, according to me.
And for the last question, what is your controversial take on the market for the rest of 2025?
So the most controversial, Vinu, and I'm contradicting myself when I say this, because just about a month ago, I was also saying that Fed is going to cut rates 2 times this year. And now I'm saying, if you take out the politics from the picture, then based on the fundamentals alone, I think there should be no rate cut in the US. Now, I'm going to be a very lonely person in that corner when I make that call, because as you know, the Fed press releases are indicating 2 rate cuts. Market has priced in anywhere from 1.5 to 3 kind of rate cuts. there aren't very many people going to be backing me on this call. But I do think, based on the fundamentals, there shouldn't be a rate cut in the US. And depending on how the Fed governors behave and who the next chair likely to be is, maybe that will be my biggest win if there's no rate cut in the US.
Well, thank you so much, ma'am, for your time.
Thank you, Vinu. My pleasure.